So far, we've looked at the stripped down potential of the candlestick patterns. We've seen how they can be used to help make trade decisions, and we've also looked at a couple of examples where we've combined technical indicators with the patterns. In this lecture, we're going to go a step further and we're going to introduce some position sizing and portfolio rules and see if we can come up with a complete strategy for stocks that uses candlestick patterns to trade. So if we think about the candlestick patterns that we've had the most success with, the inverted hammer, the loose kicker, the tweezer bottom, the evening star, clearly we have a few ideas that we can run with. What I'm going to do now is show you an example of a trading strategy that I've come up with, and then we're going to test it on some historical stock data. So let's take a look at the rules I've created so we can see how this strategy will work. Basically, this is going to be a portfolio system that is long only and based on daily timeframes. We're going to hold a maximum of 10 long positions in stocks, and our starting capital will be $10,000 with no margin used. The previous bar equity will be used to calculate our position sizing, and our position size formula is shown below, which is a very simple equal weighting formula. Simply, when we get a signal to buy a stock, we will divide our equity, in this case $10,000, by the maximum number of positions for our portfolio, in this case 10, and we will use that amount to buy as many shares as that money allows. So if we get a signal to buy Apple at a price of $50, for example, we divide 10,000 by 10, which is 1,000, and then we buy $1,000 worth of Apple stock, which equates to 20 shares, 1,000 divided by 50. So in other words, this is an equal weighted portfolio, where each position is worth 10% of our capital. And because we use the previous bar equity to calculate our position size in real time, this allows us to use compounding. Anyway, let's not get too technical. Let's get back into the entry rules of this strategy that I've set up and see how it gets on. So essentially, this system is going to buy a stock on the close whenever there is an inverted hammer or a tweezer bottom candlestick pattern. And we're also going to say that the stock should also be in an uptrend. The rule here is that the 20-day moving average, calculated using the open price here, should be sloping upwards. It's important to use the opening price here to avoid look-ahead bias. In addition, in the case of more than one signal, we're going to rank stocks by the RSI 14 indicator, the relative strength index. So if there's more than one stock with a buy signal, we're going to prefer the stock that has the lowest RSI on the previous bar. Finally, we want this to be a realistic test, so we're going to avoid illiquid stocks by ignoring any stocks that are priced under $2 per share, and we're going to ignore any stocks with an average volume under 250,000 shares. The system is then going to sell after 10 trading days on the close. Again, this is a portfolio system, so we'll be able to hold a maximum of 10 stocks at any time that meet the buy rules. After 10 days, the stock is sold and it drops off the portfolio, and then we look for a new buy signal. So whenever we see a stock with an inverted hammer or a tweezer bottom pattern, and that stock's 20-day moving average is sloping up, AMI Broker is going to buy that stock and add it to the portfolio, and 10 days later it will be sold and drop off the portfolio. So now we have the strategy rules set up. We're going to backtest the system over the S&P 1500 universe of stocks between the 1st of January 2000 and 1st of January 2015, and we're going to ignore S&P 100 stocks this time. We've already tested the pattern on S&P 100 stocks, so including them would probably be an unfair comparison. So this is a much bigger universe of stocks, and the backtest will take a bit longer to run because of that. And finally, we're also going to set our commissions to 1 cent per share to simulate trading costs and slippage. So I've run the strategy, and you can see that this system actually worked out quite well in the backtest. The strategy managed to turn our initial starting capital of $10,000 into over $40,000, which works out at a compounded annualized rate of return of 10.19%. Our maximum drawdown was quite low at 25%, giving us a CAR/MDD of 0.41 and a Sharpe ratio of 0.4. That compares to a buy and hold return on the S&P 500 index of only around 4 to 5% with a drawdown of 55%. Overall, I think these results are not bad considering these are very simple rules. The drawdown is not too large even though we have no kind of market timing filter or fancy exit rule. But this is just an example of a trading system that you could potentially create using these candlestick patterns. It's not provided as a finished strategy, and this is by no means perfect. Clearly, there are hundreds of variations and ideas you could come up with. It might be worth experimenting with different candles, different exit criteria and longer holding periods, etc. And also another word of caution, because this is a backtest, it doesn't necessarily predict the future. And we haven't done any robustness testing, such as testing different start dates, different settings, different stock universes, etc. Overall, these initial results indicate that there may be some profitable expectancy with these patterns, but when it comes down to it, I would suggest that the patterns are still probably best used as confirmation indicators. I'll now play the recorded backtest from AmiBroker so you can get a better idea of the system results.